For most of last year, Australians were told the worst was finally over. The Reserve Bank was cutting rates, mortgage holders could breathe again. And then, in 2026, the Reserve Bank did something almost nobody was betting on. It slammed the whole thing into reverse. 3 rate hikes later, every one of those cuts is gone. And if you've got a mortgage, you're right back where you started. Here's what makes this different from every other rate story you've scrolled past. This wasn't a small tweak. This was a full U-turn. Through 2025, the Reserve Bank cut interest rates 3 times, taking the official cash rate from 4.35% down to 3.60%. The logic was simple. Inflation had been falling, so the bank eased the pressure to help the economy grow. Markets expected more of the same. Most economists were forecasting further cuts rolling into 2026. 2025, 3 cuts, 4.35% to 3.60%. Instead, the bank hiked, not once, 3 times in a row. In February, then March, then again by May, the cash rate climbed right back to 4.35%. That February increase was the first rate rise Australia had seen since November 2023, and according to market analysts, it made the Reserve Bank one of the first major central banks in the world to flip from cutting rates to raising them after the post-pandemic inflation spike. StatCard, 2026, 3 hikes, 3.60% to 4.35%. Source, RBA. Think about what that means for a household. Every dollar of relief those 2025 cuts handed back, gone. Repayments that dropped through last year have climbed straight back up. The bank's own board put it plainly. After 3 increases since the start of the year, financial conditions are now tighter and the economy is slowing. This is the story of how Australia's shortest, shallowest rate-cutting cycle in decades quietly died, and why the people paying for it are the ones who can least afford another surprise. Let's walk the timeline, because the whipsaw is the whole point. Back in the pandemic, the cash rate sat at an emergency low of 0.10%. Then, inflation exploded, and the Reserve Bank went on one of the most aggressive hiking runs in its history, all the way up to 4.35% by late 2023. That's where it stayed for over a year. By late 2024, inflation looked like it was finally coming under control, and the cuts began. December 2024, then February and May 2025. 3 reductions that brought the rate down to 3.60 by the middle of last year. For the first time in ages, borrowers got a genuine break. But that break rested on one assumption, that inflation would keep falling. It didn't. In the second half of 2025, inflation picked back up. Household spending came in stronger than expected, business investment was running hot, and prices in the housing market were climbing again. The economy, in the bank's language, had too much demand and not enough spare capacity. Then came the shock from outside. Conflict in the Middle East pushed up the price of oil and other commodities. Higher fuel prices fed straight into inflation and then bled into the cost of almost everything else. By early 2026, the Reserve Bank decided a hold was no longer defensible. The data forced its hand. So it hiked in February, again in March, and again by May, unwinding every cut it had made. And here's where the numbers get uncomfortable. As of the most recent figures, headline inflation had eased slightly to 4.0% as fuel costs came off. But underlying inflation, the measure the bank watches most closely, actually accelerated, with the trimmed mean rising to 3.6%. Both are still sitting above the Reserve Bank's 2 to 3% target band. In plain terms, inflation is proving stubborn, and it's now baked deeper into the economy than a single oil spike. To put 4.35% in context, the Reserve Bank considers a neutral cash rate, one that neither speeds up nor slows down the economy, to be somewhere around 3 to 3.5%. Anything above that is actively restrictive. At 4.35, the bank is deliberately pressing the brakes. Governor Michelle Bullock and the board are betting that slowing the economy now is the price of stopping high inflation from becoming permanent. So what does a reversal like this actually feel like at the front door? Take a household with a $600,000 mortgage, fairly ordinary in a country where the national median home is now near $1 million. Undoing those 3 cuts adds very roughly $270 to $300 a month back onto their repayments, depending on their loan and their lender. That's on top of the years of increases they'd already swallowed since 2022. This is an estimate, not a quote, but it shows the shape of the squeeze. And for a lot of people, the timing is brutal. Remember the borrowers who locked in those ultra-low fixed rates back in 2020 and 2021? Many are only now rolling off them onto today's variable rates, a jump that can be enormous. It's what analysts call the fixed rate cliff, and a lot of Australian households are still walking straight off the edge of it, into a market where rates just climbed again. Then there's the raw affordability picture, which was already at record extremes before these hikes. According to property analytics firm Cotality, servicing a new mortgage now swallows around 45% of a typical household's income nationally, and in Sydney, closer to 68%. Anything above 30% is generally considered mortgage stress. So millions of households were already deep in the danger zone. These rate rises don't nudge them, they push them further in. And it's not just people with a mortgage. When repayments rise, households cut back on everything else. And that ripples through the shops, the cafes, the tradies, the whole economy. That's actually the point of the exercise. The Reserve Bank is trying to cool demand. But the people feeling it first and hardest are ordinary borrowers who did nothing wrong except buy a home at the wrong moment in the cycle. Now here's the twist most headlines miss. Higher rates are already reshaping the property market itself, and not evenly. The Reserve Bank has noted that momentum in housing has shifted, with prices now falling in some capital cities. Sydney and Melbourne have flatlined and slipped. Yet at the same time, the mid-sized capitals, Perth, Brisbane, Adelaide, and especially Darwin, have kept climbing. The national median dwelling value still rose about 8.8% over the year to roughly $942,000. So even with rates rising, Australia isn't one market crashing. It's 8 markets pulling in different directions. So where does it go from here? At its June meeting, the Reserve Bank finally paused, holding at 4.35%, unanimously, for the first time this year, while it waits to see how much damage the previous hikes are doing. But, and this matters, the bank has signaled that further tightening is still possible if inflation won't budge. The major banks are now mostly forecasting a long hold. Commonwealth Bank, for one, expects rates to stay put well into 2027 before any cut is even on the table. In other words, don't hold your breath for relief. Rate cuts are not on the agenda for 2026. For a generation of borrowers who were promised the easing cycle would continue, the message from the Reserve Bank is blunt. The fight against inflation comes first, even if households wear the cost. And that raises the real question underneath all of this. In a country where owning a home already takes a decade of saving and half your income to service, how much more can households actually absorb before something gives? So that's what the Reserve Bank quietly did. It took back every cut, sent borrowers back to square one, and told them to brace for more. Whether that's the responsible call to kill off inflation or a hammer coming down on the wrong people depends on where you're standing and whether you're the one opening the mortgage statement. I want to know what you think. If you've watched your repayments climb back up this year, tell me in the comments. Is the Reserve Bank doing its job or making a bad situation worse? If breakdowns like this help you make sense of what's happening to Australian housing, subscribe. Because next, we're looking at why house prices are somehow still rising while all of this plays out. I'll see you in that one.